We do it after class. It's too close to class. Oh. Okay, folks, an announcement before we start. Jennifer is part of a group called the Valuation Service Group. That's an undergraduate group that helps businesses that want their businesses valued, so you can get a chance to actually try this out in the real world and real. Many of them are smaller businesses that can't pay an appraiser, so they're actually looking to you for a number. So I'm going to let her describe what the group does, how it's structured, and if you're interested, you can contact her. And I will send the information about both the group and how to reach out to her after class. Go ahead, Jennifer. Use that mic.
Hello. Okay. Hello. I'll just take everyone just for a few minutes and just going to quickly talk about NYU Valuation Service Group. So right now, over these 2 weeks, we are conducting e-board and also general member recruitment for this club. So NYU Valuation Service Group is a pro bono NYU student organization that offers financing or strategic business decision consulting, or even just advice for potential M&A solutions for small businesses, not only in New York City, but also across the entire United States region. So if anyone here are interested in either a leadership experience or you want to practice your valuation technicals, we conduct DCFs and also sometimes LBOs as well. So not really about pricing, but mainly for intrinsic valuations. Or you want to just talk to clients, talk to CEOs and founders of startups. So if you're interested in VC or creating your own startup in the future, this will be a great opportunities. Yeah, so I'll send you the application link if you talk to me later after the class, or you can find it in professor's email later. So we are open for both underclassmen, upperclassmen. Either if you have valuation experiences or not, we are all welcome, open level. Or so also it's either e-board or general member. So feel free to learn more as a general member before you apply to e-board, but all welcome. Thank you so much.
Thank you, Jennifer. The LBO I would take out. Don't do any LBO stuff. You know, you don't want to get somebody bankrupt by letting them borrow too much money. Bankers can get away with it because it's other people's money, but these people might actually know where you live, or at least where you go to school, and that's a dangerous place to be. Usual 2 questions with a reframing. So the first question is, how many of you have not picked a company to value yet? Subtle change from last week. How many of you not picked a company? You do know that I know you're lying, right? Because I can see the master list and it's not all filled up. So either you picked a company and not put it into the master list, or you've not picked a company. I'm not going to put you on the spot. God's sakes, what are you waiting for? Just pick a company, start the process soon. Better to pick a company and change your mind later than not to pick a company at all. Second, I did get a couple of emails from people who don't have a group yet. So the best way to actually create a group is actually ask people that are not in a group. And if enough of them put up their hands right now, you can create your own group after class, right? How many of you are not in a group yet? Really? Nobody? So who's emailing me saying I'm not in a group? Okay? So if you're not in a group, you're not in this classroom, right? Okay, so everybody's in a group, at least in theory. Most of you pick companies. I'm going to keep my delusions going, so I'm going to act like that is true and keep moving, because even though I know it's not. So today we're going to talk more about equity risk premiums. If you remember, last Wednesday we talked about how to estimate the historical premium by looking at the past, why it's such a bad estimate for the future, right? It's noisy, it's backward looking. And then we talked about estimating risk premiums in other countries. I hope you had a chance. Jeez, not a fire alarm. Okay, let's hope that was just a one-time fire alarm. I think you're okay ignoring it. If it starts blaring, I have to get you out of here. No. But today we're going to talk about a better way of estimating equity risk premiums, a forward-looking estimate. So today's start of the class test is going to be structured around what exactly that estimate is and what we're going to try to do. Is everybody comfortable with how to compute a yield to maturity on a bond? Okay, tell me how you compute the yield to maturity on a bond.
So you have basically however long the bond is, and then you have whatever the face value of the bond.
Okay, so let's pause right there. When you buy a bond, it comes with a maturity and a face value, right? What else does it come with?
It comes with
Coupon. Do you get something every? So you get a coupon, a face value, and a maturity, and then you buy the bond at a price. So what's yield to maturity? So you got the price, you got the coupons, the face value. You try different discount rates to find the internal rate of return. That discount rate that makes the present value, the coupons, and the face value equal to the price of the bond. We do this in fixed income all the time. It's a forward-looking number. It changes all the time. So my question is, why can't we do this with equities? It's a little messier, right? Instead of buying the bond, what are you doing? You're buying stocks today. So you both go buy the S&P 500. Do I know how much you paid for it? Yeah. It changes every moment of every day, but you buy this. Do you expect to get cash flows? Yeah. But not coupons, right? What do you get instead? Well, you don't even get residual claim because you don't control the companies. You get dividends and maybe buybacks. And I can't tell you what they will be in the future, but I can tell you what they were last year. So I know what you paid for stocks. I know what the cash flows were in the last 12 months. Can I forecast what those cash flows will be in the future? Yeah, we can try, right? This is the most, if it's the S&P 500, the most tracked index in the world. There are people estimating growth in earnings and cash flows, and I project out the cash flows. And unlike a bond, which comes with a finite maturity date, stocks go on and on and on forever, and I can't estimate cash flows forever. But here's the escape hatch. These are the 500 largest market cap companies in the economy. They can't grow faster than the economy for very long. So the end of year 5, assume that the cash flows and earnings will start to grow at the same rate as the economy. And you're going to see me do this over and over in valuation. I'm going to assume the risk-free rate as the proxy for that long-term growth rate. So I'm almost there. I've got your expected cash flows, and beyond year 5, they will grow forever at the risk-free rate. And I ask the same question I asked for the bond. What discount rate will make the present value of the expected cash flows equal to the level of the index? It's the same kind of problem. It's a little messier because you can't just do yield to maturity kind of calculations. You have to try. It's a trial and error, but in Excel you can use the solver function or the goal seek function if you want to save yourself time. But eventually you'll end up with a discount rate. What does that tell you? It tells you based on what you paid for stocks, what you can expect to earn as a return on stocks. I'm almost there. If I subtract out the risk-free rate from that, I have an equity risk premium for stocks. I'm going to show you what it looks like at the start of 2025 and what its history looks like. But before I do that, I want to ask a few what-if questions, because if you take this as a forward-looking number coming from what you're paying, here's my first question. Let's say that stocks go up by 20%. Okay? The index level is up by 20%. So go back to the calculation before. If your index level goes up by 20%, what should happen to your equity risk premium? Should it go up? Should it go down? Should it be unchanged? Or is there more information you need to answer that question? Do you see my question basically? Let's go back to the fixed income example. Bond price and interest rate. There, if the bond price goes up, what happens to interest rates or the yield to maturity? It goes down. Prices and interest rates move in opposite directions. Is that going to be true with stocks as well? For the most part, and I'll tell you why it's not the same. With a bond, the coupon is always fixed. So when prices go up, the interest rate has to drop. Here, the price of stocks goes up. I didn't tell you what happens to earnings. What if earnings and cash flows also go up by 20%? If the level of the index goes up by 20% and the earnings also go up by 20%, your equity risk premium is going to remain the same. What drives equity risk premium is not whether the stocks go up. but how much they go up relative to earnings. If they go up a lot more than earnings are going up, your equity risk premium is going to decrease. If they go up by less than earnings are going, the equity risk premium could actually go up. So it's easy to make mistakes with equity risk premiums because you think of them like bonds, but stocks are more dynamic. The cash flows can change, the growth rate can change, and you're trying to get a sense of what the equity risk premium is doing. Okay? Another question. No, we go through crises every 3 or 4 years. There's a crisis. 3 or 4 years ago, it was COVID and a pandemic. Now, again, forget the math. You've priced stocks. A crisis hit. Usually, when a crisis hit, what happens to stock prices? They go down. So, what should happen to equity risk premiums? They go up during crisis, which is exactly what you'd expect. So, I'm going to track you through what the equity risk premium did day by day from February 14th of 2020, which was the day that we heard that the Italians were having a problem with COVID in Italy. So no longer a Chinese problem on cruise ships, it was all over the world. We all woke up to the reality that this was a global pandemic from February 14th of 2020 to March 23rd, one of the worst 6-week periods for US equities in a long, long time. We'll talk about what the equity risk premium did during that period and how to compute it. So that's an implied premium. I've laid the foundations. But before I go there, let me go back to where I left you with the lecture notes. We're talking about estimating an equity risk premium for a company. Ciara, remind me again. So if I have a company and I want to estimate an equity risk premium of the company, what do I need to first find out? Where it operates, right? So I can tell you where it's incorporated. So if you have a Saudi company that operates only in Saudi Arabia, my life is easy. But if it's a Saudi company that operates in Saudi Arabia, but also in Egypt and Libya, I've got my task laid out for me. I've got some risky countries in here. And then in the approaches we used, at least through last class, what did I do? I took a weighted average of the equity risk 3 countries are in, with the weights based on revenues. And I told you at that time, I'm using revenues because I'm desperate. It's the only number I can find broken down by country. And it's the only number that's always going to be positive. Do you see why that's a factor, right? If I weight based on EBITDA or EBIT, the problem I'm going to have is some countries can have negative operating income and I can't weight based on negative numbers. So it's convenient. But can it get me into trouble? Absolutely. By focusing just on revenues, I might be missing big parts of country risk. I'll give you an example. Embraer. Brazilian aerospace company gets about 97% of its revenues outside Brazil and primarily in North America and Western Europe. So if I look at just revenues, Embraer looks really safe. It's like a US company. It's like Boeing. But all of its factories are in Brazil. If Brazil goes to hell in a handbasket, Embraer is going with it. I'm ignoring where you make stuff, the production part of it. And second, the question is, what do I do with that country risk premium? Should I scale it if you're a high beta company? Is beta even the right measure of risk if I'm talking about country risk? So I want to take those 2 questions first today. Let's start with what to weight operations by. If you're a consumer product company, revenues work fine. You're Coca-Cola because most of your money you make from pricing up, what cost you 3 cents to make for $3 and selling it. But I'll tell you, give you an example of a company where you sell your stuff is completely irrelevant. If you're an oil company, what keeps you up at night? Not where you're going to sell the oil, but where you get the oil, right? If you're getting a lot of oil from Nigeria and Kazakhstan and Brunei, you got to think about what the country risk is in those countries, and that's all you care about. So a few years ago, I valued Royal Dutch. Royal Dutch, old-time oil company, integrated because it does everything in the oil space. And to get an equity risk premium, here's what I did. I looked at where they got their oil and gas. And most oil companies, if you look through the footnotes, there will be a table. And Royal Dutch had this table of where they got. Scary thing about oil is it's put in the riskiest parts of the world. Or maybe the converse is true. Once you get oil, it becomes risky. But whatever the connection is, you take the parts of the world that Royal Dutch has oil and gas production, and you take a weighted average. That 11% in Iraq, the 10% in Russia all play out. to give them an equity risk premium of 8.26%. That was actually higher than what I was using as an equity risk premium for many emerging market companies. If you're an oil company, I don't care where you're incorporated and traded, you're going to be a risky company because of where you get your oil. Right? And you could already see that if you're valuing an oil company that is primarily US and Canadian based, as opposed to an oil company that it's half its oil in Venezuela or in Russia, you're going to have a much higher equity risk premium for the latter than for the former. So you can use revenues, you can use production, can you use both? Valuation, you can do whatever you want, right? You say, how do I decide how much to use of both? Well, one of the things to look at is how much in this business do I care about production? I'll give you an example. If you're Infosys, outsourcing company, your software people, your employees might all be or primarily be in India. Your revenues might come from outside the US. But your production is pretty mobile, right? So if something bad happens, you can take those people, move them to a different part of the world and try to insulate yourself. But if you're Tata Motors and you have physical plant on the ground, it's going to be much more difficult for you to do it. So one of the things I'm going to factor in how much you weight production is, hey, how easy is it for me to move production? The easier it is to move production, the more you're going to focus on revenues. The less so, the more you care about, where your production is. So that's a factor that's going to play out. And if you want to use both, just make sure the weights add up to 100%. That's your only rule. You can bring both in. There's no one rule that's going to work for every company. So for your company, ask yourself, where is the risk coming from? And use it to come up with an equity risk premium that reflects it. Any questions? Yeah.
At a financial services firm, like
It's tricky, right? So, yeah. That's a good point, right? So again, the test I run is actually an intuitive test. If I were the CEO of that bank, what's keeping me awake at night, right? Yeah, where your loans are, right? So it's not who the regulator is or where my incorporation is, it's where my loans are. So absolutely, yeah, it's what you're going to factor in. Any other questions about the weighting? Yes. So, Sophia's bringing in a wild card in here. We talk about supply chains, right? What did we learn during COVID? If your supply chain runs through the riskiest parts of the world, God help you, you might not make it. So supply chains matter as well. So one of the ways to think about this is if you have a supply chain that has some look at the weakest link in your supply chain, because if that piece breaks, the whole supply chain breaks. You want to factor that in. This is actually not just a valuation tool, it's a business management tool, right? When you decide how to build your supply chain, I'm going to give you the consequence. Say, if you do that, you're going to have a higher discount rate because you're going to say, that supply chain is cheaper. And say, okay, that's fine. But because you have to run through some of the riskiest parts of the world to deliver it, I'm going to give you a higher discount rate. So I want you to think about all of those things when you think about country risk. You might still have to come up with a pragmatic way of saying, I can't spend the rest of my semester thinking about country risk. But think about the dimensions that affect what the value of your company is. Okay? Now, the other problem I pointed to is beta a good measure of country risk? Remember I said you multiply the equity risk premium by beta, you're making a leap of faith. That beta that was designed to capture exposure to all other risk works with country risk as well. But country risk is kind of unique, right? Yes. Remember, there are two components to your value. There's cash flows and there's a discount rate. What you've described is a cash flow effect. It's a very morbid payoff. But if you're a company that makes munitions, war is good for you because it pushes up revenue growth, might even push up margins, push up value. It's not a discount rate effect as much as a cash flow effect. And that's something I want you to think about. Sometimes we're thinking about things that affect cash flows and we try to bring it into discount rates. So discount rates are blunt instruments. You can't bring in those issues. It's a cash flow effect. So let's talk about what else might affect country risk that makes it unique and different from interest rate risk or macroeconomic risk. The first is that when you have country risk, there are things you might do as a company that reduce your exposure to that country risk. Like what? You might be able to find insurance against certain types of country risk. Maybe one of the risks you worry about is nationalization. You might be able to buy very expensive insurance, but insurance against it. But what might tar you as a high risk company often is if the government decides you're a company in the national interest. When I value companies where the government has said you're in the national interest, it's terrifying because you know what's coming down the pike, right? Because that government is going to bind itself with the company, and everything bad happening to the government will happen to your company as well. Okay? So one of the ways to think about this, maybe beta is not the right measure of country risk. Maybe we can come up with a different measure that measures exposure just to country risk. I'll tell you when I concocted this. Keyword is concocted, not derived, because that suggests deep thought. It was on a trip to Brazil 20 years ago, and I was going for a valuation seminar. I was valuing two Brazilian companies. Okay? One was Embraer, the company that I just described, and the other company is a company called Embev. At that time, just a Brazilian beverage company, makes a lot of beer. At that time, I was doing what bankers did, which is treat them both as Brazilian companies. And it was a long flight. The person next to me was oozing into my seat, and it was difficult to fall asleep, which was good because I could work on my slides for the next day. So I'm going through and I have Embev and I have Embraer, and I'm giving them both the same risk premium. And I think that's not fair. Embev gets 100% of its revenues in Brazil. Embraer gets 5% or 3% of its revenues in Brazil. I'm treating them both as Brazilian companies. Wouldn't it be nice, and this is the thought that goes through on a flight in 30,000 feet up in the air, if I could come up with a measure of how exposed each of these companies is to just Brazilian country risk? So I concocted this measure. I called it lambda. Why? Because I realized that attaching a Greek alphabet to whatever you do attaches a layer of sophistication to it. And basically, lambda is my analog to beta. So lambda scaled around 1. So if your lambda is 1, you're as exposed as the average company in the market. Lambda above 1 means you're more exposed. Lambda below 1 means you're less exposed. So if I asked you, given the two companies I described, Embraer and Embev, one is going to have a really low lambda and the other is going to have a really high lambda, right? Which one's going to have the low lambda? Embraer, because it gets most of its revenues outside. So I started thinking about what else would I like to bring into this lambda? I actually wrote a piece while I was on the flight still. It's still on my webpage on all the things I would like to know to measure lambda. I started with the most simplistic measure of lambda, which is based on just revenue exposure. Why? Because the one item you can get. And I said, you tell me what percentage of your revenues you get from a country, I can convert into a lambda. So here I've taken two Indian companies, Tata Motors and Tata Consulting Services, both part of the same family group in India. They're both Indian companies, both part of the same family group. But here's where they're different. Tata Motors gets about 91% of its revenues in India. Tata Consulting Services gets about 7.6% of its revenues in India. Already, if I asked you for direction, Tata Consulting Services will have a lower lambda against country risk than Tata Motors because it gets less of its revenues. But I want to convert it into a number that's scaled around 1. So I looked up a third number. I looked to see what a typical Indian company gets as revenues in India. And the typical Indian company, when I did this analysis, gets about 80% of its revenues in India. I'm home. Here's what I did as the final step. I took for Tata Motors the 91% they get in India divided by the average of 80%. And you have a number that looks just like a beta, right? 1.14 lambda. I'm going to take the Indian country risk premium and multiply by 1.14. In contrast, if you take Tata Consulting Services, take the 7.6 and divide by 80, the lambda you get is 0.09. Effectively, it means when I compute the cost of equity, the expected return for Tata Consulting Services, I'm going to have far less exposure to country risk. It'll still be lower, but it might not be as low. So the question was, I said that Embraer, just looking at revenues, I'm going to get, and that's still going to apply here, right? The lambda I'm going to get is going to be really low for Embraer because 3% of your revenues will give you a lambda of like 0.05. And I'm still exposed to that critique of where does where are your production facilities? And if they're all in Brazil, that should come into lambda. The direction is probably still going to be the same. The lambda is going to be lower. It's just not going to be as low as 0.05. But you raised a good point. Why are you still focused on revenues? Is there a better way to do it? And there is one, and you can try this out. You know how we get betas? We run a regression of returns on the stock against returns on a market index. It measures how sensitive my stock is to market movements. That's what beta measures. What am I trying to estimate here? I'm trying to estimate how sensitive my company is to changes in country risk. So hang in there. Here's what I did. I took returns on Embraer and returns in this case of Embratel, which is a Brazilian phone company, which gets all its revenues in Brazil. I ran regressions against returns on what's called a C bond. A C bond is a dollar-denominated Brazilian bond, and I computed the percentage return each month. Think of what drives that return. If Brazil is having a crisis, the price of the bond drops, the return goes up. So essentially, I have a return every month that captures changes in country risk. And I ran the regression. The slope of the line basically is like a beta, but it's measured specifically against country risk. So here's the output. When you run this regression, the Embraer returns give me a slope of 0.27. What does that mean? Every time the return of the bond increases by 1%, Embraer is up only 0.27%. Drops by 1%, it's down by only 0.27%. It's not that sensitive to returns of the bond. And do the same regression for Embratel, the coefficient I get is 2. For every 1% movement in Brazilian country risk, Embratel is twice as exposed. Now I have a measure that captures not just revenues, but everything that's happening in the company, because the market has to react to the composite effects, where your costs are, where your revenues are, and your total profits. You could, but be very unusual, right? Because basically that means you're actually working in the opposite direction as your country. I've never seen it happen, because you'd have to disconnect from your country in a way that, it's very difficult for me to see a negative number. But if it is, basically it means that this is not the country risk premium you should be worrying about. There might be other countries you have to bring in. But I would not use that in a cost of equity calculation, because it measures, at least from my perspective, nothing of value. Yes?
Variable companies for the lambda, or just all companies?
For this regression, or for the previous page? You'd have to use all companies, because the lambdas have to add up to 1 across all companies, right? So if you do it by sector, you'll get this strange not adding up of numbers. That's why when you do betas, when you run regressions, what do you suppose to run the regressions against? Against the market, not against the sector returns. Exactly the same reason. Okay? So here's what I'd like to do. I've laid out all these different approaches. At this stage, you're saying, well, these numbers are all going to give me different answers. I took Embraer, this was in 2004, and I computed 5 different expected returns. Remember, these are going to be discount rates used to discount cash flows. In 2004, I did everything in US dollars. Saying that's a cop-out. I'm guilty as charged. You know why I did it in US dollars? Because in 2004, the Brazilian government did not have 10-year bonds denominated in reais. If the Brazilian government doesn't want to deal in reais, why should I deal with reais, right? So basically, I stayed with T-bonds. So what you see is the risk-free rate here, because I'm doing everything in dollars, is the US T-bond rate, 4% at that time. The beta is the same, and we'll talk about how to get a beta for a Brazilian company. So for the moment, take the beta as a given. But I've computed 5 different expected returns based on, first, what I have as my country risk premium. So in the first approach, I just added the entire country risk premium for Brazil to my expected return. It's the Brazilian company, you get 7.89% more. In the second, I took a weighted average risk premium, reflecting the fact that I get only 3% of my revenues in Brazil and the rest in the US. So I get a much lower cost of equity because I'm now bringing in the US exposure. In the third approach, I went back to using the country risk premium, but then I multiplied by the beta. I have 5 different costs of equity, but rather than look at them as 5 different numbers, notice they cluster around two groups of numbers. In those expected returns where I treat Embraer as a Brazilian company and don't factor in where they get their revenues, I get much higher numbers, 16, 17, 18%. In those calculations where I bring in the fact that they get a big chunk of their revenues outside, I get an expected return that's much lower, 9, 10%. But valuing Embraer. Okay? You could use the 16 to 17% you get treating it as a Brazilian company, or the 9 or the 10% that you get by treating it as a Brazilian company with significant developed market revenues. Which one's going to give you the higher value? The second one, right? Your lower discount rate. But I'll make a confession. I think markets take emerging market companies and use a bludgeon on them. And especially during crisis. Okay? So if you look at what happens when you have significant developed market exposure for an emerging market company, is if markets don't discriminate across companies, if Brazil is hit with a crisis and investors sell off Brazilian stocks, they sell off Embraer just like they do Embev or Embratel or any other Brazilian company. So I want you to think like an investor and say, look, markets are doing the wrong thing. They're factoring in the risk by looking at where a company is incorporated. They should be factoring in where you get your revenues. Okay? If that is your starting point, tell me how you would try to make money off that mistake. Because markets are making a mistake, right? They're treating all Brazilian companies as the same, even though Embraer gets as much of its revenues from the US and Western Europe as Boeing does. So what will be the outcome you will get as an investor if you believe markets are making mistakes? What kinds of companies will look undervalued and overvalued to you? Or less exposure. So the Embraers and the TCSs and the Infosys of the world, if you're looking at India, in pretty much every emerging market, there's a few companies are going to be priced too low. So what are you going to do? You're going to buy them, and Sophia, what has to happen for you to make money? They have to come to their senses, right? And how do you get them to come to their senses? You sit and you hope. You know what usually makes them come to their senses? Is you get the reality check. What do we say about these companies? They are, in a sense, not as exposed to what happens domestically, right? So when they report their earnings in the middle of a crisis, their earnings actually hold up, even as the countries, and because Embraer still got the contracts, the long-term contracts. So maybe the first quarter people don't notice this, but after about the third or fourth quarter, where their earnings still come in at good numbers, where the rest of the market is melting down, maybe then, there's no guarantee, maybe then the correction will happen. I have a list of emerging market companies like Embraer that I put together. The list is dated now, but you could probably create a list like that. Take each emerging market, take 2 or 3 companies like Embraer, which get the bulk of their revenues from developed markets. Don't do anything crazy. Just track those markets until there's a crisis. You know, what if there's no crisis? It's an emerging market. Of course there's going to be a crisis. It's going to be political, it's going to be economic. Crisis, everybody's going to sell everything, run for the exit, and you have a buy order ready to go. That's the time to buy the stock. I bought Embraer when Lula got elected for the first time in Brazil. For those of you not from Brazil, Lula, when he got elected, was viewed as a communist, that he was going to nationalize everything. Market just completely collapsed. And I remember Embraer trading at an incredibly low price, was being treated like every other Brazilian company. It had all these contracts still with North America and Western Europe that were still there. And I rode basically the market coming. It took a long time, about 7 years before I could cash out. But it's a strategy to think about. It's a strategy built on the premise that markets sometimes are lazy and sloppy in the way they treat emerging market companies. Can you think of the inverse strategy in a developed market? What are the companies you're going to sell short on? Because it's not long. What are the companies that are going to, if market, yeah, go ahead. So if you have a company with 80% of your revenues in Argentina, and it's a US company, and people are pushing up the stock price because it's a US company, say stop. This doesn't make any sense. So the inverse of that strategy is to take a company like Coca-Cola and they get pushed up and say, you have a lot of emerging market risk here you're ignoring. So from both sides of the mistake, you're trying to exploit the possibility that those mistakes will get corrected. So look at the different approaches. Fundamentally, the big difference between the two approaches is, are you going to treat your company's risk based on where it's incorporated? Are you going to treat your company's risk based on where it does business? I think the latter makes sense, but the market might disagree with you for a long time before it finally fixes that mistake. Any questions? Yes, go ahead.
Factoring risk from clarity between a company that's incorporated in the Cayman Islands, for example, they might not have like as precise financial statements or not as regulated, to a company that's incorporated in the US, but both of their revenues are almost completely.
I think the question is, does the place of incorporation matter? If you, let's say you have a company with 100% of its, two companies with 100% of their revenues in the US. Let's face it, you get none of your revenues in the Cayman Islands. It's a really, really, really tiny market, right? The only reason you're there is either for taxes or because you want to create an opaque structure where it makes it difficult for somebody to take you over. I think it's more of a corporate governance issue than an opacity issue, because when I look at financial statements in the Cayman Islands, they're just as complete as the financial statements in the US. Because if you're going to trade in the US, which is what a lot of Cayman Island companies want to do, your disclosure requirements are covered by where you choose to list your stock. You could try to list it in the Cayman Islands. I don't even know whether anybody trades in the Cayman Islands. So when Alibaba was listed, it was a Cayman Island shell company, but the trading was in the NASDAQ. So it's not so much a disclosure issue as a corporate governance issue. What does that mean? If you don't like the way the company's run, tough luck if you're looking at a Cayman Islands company, which could then affect value, because if the company gets badly managed and badly run, there's nothing you can do to fix it. Any other questions on country risk? So now let's set up the implied equity risk premium piece. Right? Again, the intuition is very simple. It says, look, don't look at the past. Don't ask people what they want as an equity risk premium. Just look at what they pay, because that is a number with its actual dollars going in, and it reflects what you think about risk. And you're doing what you do with a bond. You're trying to look at what's being paid and try to back out of that number what kind of expected return. The intuition here is, if you get scared, stock prices go down, your expected return goes up, and I want to build that into the system. So that's the page you saw at the start of the class. Basically, it's an expected return, the IRR calculation. And I do this at the start of every month. And I started doing it at the start of every month in 2008. And I'll talk about why I didn't do it every month. Before that, I used to do it once a year. So start of February, and I'll send you the most recent implied equity risk premium number. I do the start of every month for the S&P 500. So let's look at what the number looked like in January 2020. I came into 2020 saying, this is going to be a good year. How little I knew what was coming. So I took the level of the index, so there's the index. Expected cash flows based on what the cash flows in the most recent 12 months. And then I use, and this is the basis for most of my projections, I look at what analysts are projecting collectively as growth in earnings for the index. Because I don't want to be sitting there estimating earnings growth for each of the 500 companies. And the start of 2020, the estimate was earnings growth of about 4% a year. So I projected out the cash flows for the future. At the end of the fifth year, what happens? I assume that cash flows will continue to grow, but at the risk-free rate then, which is 1.92%. So I've got my index level, I've got the expected cash flows in the next 5 years, and after year 5, the growth drops off. I'm solving for this R, this discount rate. As you can see, it's a little messier than a T-bond calculation, but you can do trial and error. Start with 6, go with 7. Ultimately, the number that made my present value of the cash flows equal to the level of the index was 7.12%. Let me pause right there. What does that tell me? I don't care what you hoped you would make, what you prayed you would make, what you thought you would make at the start of 2020. If you bought stocks at the start of 2020, your expected return based on the cash flows and what you paid was 7.12%. This is not theory. It's basically an IRR based on what you paid. There's no built-in abstraction about theory here. You've essentially priced stocks to earn 7.12%. As opposed to what? You could have put your money in something risk-free, which then would have given you 1.92%. That difference is an implied equity risk premium. Why implied? Because I'm backing it out of what you paid. Could that number change? Go back to 2020, right? Started 2020, you're feeling pretty good, 5.2% premium. And you keep feeling good until February 14th, and then all hell breaks loose. You got a pandemic, the global economy shuts down. This is the implied equity risk premium by day through 20. I used to torture myself every morning. I had nothing better to do. I was stuck at home. So what's the equity risk premium right now? Okay. And I did it by day, so there's the graph. So that's February 14th. Okay? And then you see the equity risk premium climb. Think of why, right? Step back from the numbers. What's happening? The world is shutting down around you. You've been asked to go home. You're saying, we're not sure whether you'll have your job when you come back or whether there'll be school when you come back. We're terrified. It's amazing how, in hindsight, we put that all away. You see, always knew this was going to be okay. Did you? There are days in March, I said, I don't know where this is going to end. People were terrified, and it manifested itself that by the time you get to March 20th, in 6 weeks, this is the S&P 500, the implied equity risk premium rose almost to 8%. This is the essence of a crisis. The price of risk just dramatically explodes in a short period. Because the earnings and the cash flows can't be changing that dramatically over that period. What was different about 2020 was how quickly the market came back from the crisis. In 2008, when this happened, exactly the same phenomenon between September and December of 2008. It took 5 years for the market to get back to pre-crisis levels. In 2020, by September, market was back again. The market was far more optimistic than experts were that a vaccine would be discovered and that the economy would be okay. And experts think the market's crazy. In hindsight, though, turned out the market was right and the economists were wrong. This is the advantage of implied premiums is you can track, especially during, and I do this in every crisis. I go back to basics because it keeps me sane. If you listen to people during a crisis, you will lose your head, right? They're going to give you advice that's either terrible or extreme. Essentially, this says the world hasn't ended. Let's figure out what this means for equity risk premiums. So I've done that, as I said, start of every month. Start of 2025, I estimate the equity risk premium for the S&P 500. Same process. Index now is at 5,831 or 881.63. I did the projected cash flows, again, based on cash flows in the most recent 12 months and the expected growth in the future. Nice thing about doing this for the S&P 500 is, as I said, this is the most tracked index in the world. Getting these numbers it takes me 15 minutes at the start of every month to do it. Not just pulling the numbers from online. At the start of 2025, the expected return on stocks is 8.91%. That's better than the 7.12% that you had at the start of 2020, right? But what are you comparing this number to? A T-bond rate of 4.58%. That difference of 4.33% is the implied equity risk premium at the start of 2025. I have the February update. I'll send it to you. It means, let's see if we can guess which direction it went. What did the S&P 500 do between January 1st of 2025 and February 1st of 2025? I know you haven't been, yeah. Go the other direction. It went up a little bit. Good catch. Yeah, it did go up a little bit. It went up to just above 6,000 from 5,000. So if I hold everything else constant, the index goes up. The expected return is going to go down, right? The T-bond rate went up a little bit from 4.58%. Already you can see what's going to happen to the equity risk premium, right? Stocks go up, the T-bond rate goes up a little bit. The equity risk premium went from 4.33% to 4.27%. You think that's not much of a move? Unless you're in a crisis, that's a kind of move you'll get on a month-to-month basis. You know where I use this number? Every company I valued in January of 2025. The equity risk premium I used for the US and mature market operations was 4.33%. Just a couple of days ago, in fact, yesterday, I was valuing Titan Cement, which is a Greek cement company, and Enka, which is a Turkish construction company. And we're now in February. So guess what I was using as my equity risk premium for the US and mature markets? I'd moved to 4.27% because that's a premium. What will it be in March? I have no idea. It's forward-looking, it's dynamic, and it animates everything I do in valuation that month as my base from which I build off all my other equity risk premiums. Any questions about the mechanics of what we're doing here? Because it's not complicated, but it's messy. right? It's the same internal rate of return calculation, but it's messy because you have to estimate the say, and every time I do this, I get people saying, "What if you got the growth rate wrong?" Yeah, I could have. The analyst estimates could be wrong. In fact, they are wrong. But as long as they're not biased, I'm okay, right? So you know how I check to see if they're you know what I mean by bias? If they're consistently too high, I have a problem. If they're consistently too low, I have a problem. How do I check for bias in analyst estimates? It just gave you the definition of bias. You're wrong in the same direction. I I don't need any, basically I have 20 years of forecast from analysts. I have 20 years of actual earnings, and I look to see year to year whether analysts were above or below the actual. They're never exactly on the number. They're going to be wrong. And in the 20 years, I think in 11 years, they undershot growth. They underestimated growth. In 9 years, they overestimated growth. It's pretty close to what you'd expect. So I'm okay using the estimates even though they're wrong. But if they were biased, then I might have looked for a different source. Okay? Essentially, I'm using forecasts to get what I think the equity risk premium is today. Now, one of the big questions, and it's a question that I think you will be faced now that you're viewed as having taken a valuation class, you basically know what to say about the stock market is the market in a bubble? Why are we asking that question? Why is that question so common out there right now? Why do you think people are asking the question? But why so common now? First is you look at multiples like PE ratio, they look really high. And the second is, have you come off two really good years or really bad years for the market? We've come back-to-back 25% return years. We haven't had back-to-back 25% years in like 3 decades. You have to go back to the 1990s. Anytime you have an extended up run in the market, the bubblers come out of their caves. And you know what follows, right? Stocks are overvalued. You got to sell everything. You got to head with us into the caves. We'll stay there till it's safe again. I've seen these bubblers every year since 2012. If I'd listened to them, I'd have been out of stocks for the last 13 years. So I'm going to give you a different way of framing, is the market too expensive or not? We compute an equity risk premium, 4.33%, right? That's not your view, my view, it's what the market is building in. One way to think about whether markets are overpriced or underpriced is to ask, is that a fair premium? Is 4.33% a reasonable premium to earn on equities? So let's try that. Do you think that's a reasonable premium? Yeah. So in which case, what are you saying about markets? They're fairly valued, right? Anybody want to take the view that it looks too low? I mean, let's face it, there are all these macro things coming up, tariffs, trade wars, kind of scary stuff. Anybody want to take the view that maybe the risk premium should be higher than 4.33%? Well, you should be able to. And if you say that, let's say you think the equity risk premium should be 6%. What are you saying about stocks? Forget about the stock getting more risky, that they're overvalued. Anytime you tell me the equity risk premium need is higher than today's number, you're saying stocks are overvalued. Anytime you say that's about reasonable, you're saying they're fairly valued. And anytime you tell me that number looks too high, then there might be people who are saying AI, and it's going to do all kinds of magical things. Maybe it'll make the world a less risky place. I don't think that's true, but maybe that's what your story is. And maybe that what follows is, I'm going to take a 3% risk premium. So the question is 4.33% a high number, a low number, or a reasonable number, right? So what's a good place to try to address that? What have I done in this graph, you think? I've computed the implied equity risk premium at the start of every year with no hindsight bias. So basically, I went and put myself back in 1960 and I said, if I don't know what's coming, what's it? And I've computed the implied equity risk from the start of every year going back to 1960. Saying, how does that help me? First, take a look at this number. Is it kind of gone up and down? Yeah. 1970s, the number shoots through the roof. What do you think caused equity risk premiums to rise so much in the 70s? Politics almost never affects. That's the nice thing about me in a mature market. You can have presidents being impeached or getting close to impeached, market keeps going. That's a sign of, that's good. Actually, it's a sign of a healthy market is when what happens to the government actually has only a residual effect. So it wasn't Watergate. Inflation. Inflation is deadly for oil price embargo, etc. triggered it. High inflation is tough because when inflation goes up, everything gets scarier. If that starts to ring a bell, that's what happened in 2022, right? Inflation went up, equity risk premiums popped up. So inflation drove backward. In fact, in 1978, the Dow was at 750. There were only three numbers in the Dow. Think about that, right? Where's the Dow at right now? 30,000? I remember the headline Business Week ran, stocks are dead. You know what you should learn from this? When business magazines claim that stocks are dead, it's the right time for you to buy stocks, because if you bought stocks in 1978, for the next 21 years, take a look at what happened to equity risk premiums. Remember, when equity risk premiums go up, stock prices are collapsing. Now that they're coming down, one of the great bull markets of all time. Like the equity risk premium kept going down, 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 and during the 90s, it basically fell through the floor. By the end of 1999, the implied equity risk premium in the US, started 2000, was at 2%. Now let me ask you the question. Let's say this was 2000, and I said, the T-bond rate is 6.5%, which is where it was. I'm going to offer you 2% more than that to invest in stocks. What's your reaction going to be? Not enough, right? But you know what? Not a single person was asking that question then, because we thought the internet had solved all economic problems forever, that we'd never see another recession again. We were wrong in hindsight, but people justified it. That's a bubble. When you look at it 2%, say, there's no way. So the risk of cutting, of course, 2008, you see the spike. That's a 2008 crisis. There's COVID. So all the crises are built in there. Where are we now? 4.33%. We're asking, is that it's clearly not 1999. It's not a slam dunk bubble. I actually computed the average premium across this entire time period, the implied premium. This is not a historical premium. The implied premium from 1960 through 2024 is about 4.25%. So the sanguine answer is to say, hey, over the last 64 years, the implied premium has been roughly 4.25%. That's where we are today, so everything's okay. But I'll give you a cautionary note. Since 2008, the implied equity risk premium in the US has been about 5 to 5.2%. We're well below that now. So there is an argument to be made that stocks are overpriced. Maybe not bubble territory, that we become a little too exuberant about recessions and bad things that can happen, in which case you have a basis for saying stocks are overvalued. I'm not going to hold them. Yes, Sophia?
What's normal?
That's exactly right. And it's not just that, right? In this case, it's not just what you were used to, it's how risk averse you are. And that's healthy, right? So if you're risk averse and you think this is a richly priced market, maybe you'll invest less of your money in equities than you otherwise would have. And that's a good response to have to equity risk premiums. I describe myself as a non-market timer. What do I mean by that? I don't try to time markets. You know why? Because I'm terrible at them. You got to learn in investing what you can do reasonably, and which is another way of saying I've tried in the past to forecast which direction equity risk premium is, completely random. That's why I stay with today's implied equity risk premium when I value companies, because they say, look, you asked me to value Coca-Cola, I'm going to value Coca-Cola for you. I'm not going to try to pass judgment on the S&P 500 while I'm valuing the company. Now, a couple of tangents I want to take here. Since I've computed this implied equity risk premium each year, I was interested in a couple of questions. First was, does the implied equity risk premium become bigger when the risk-free rate is higher? And I'll give you the intuition for that. Let's say you demand a 4% equity risk premium and the T-bond rate is 2%. Right? Let's say the T-bond rate goes from 2% to 5%. This is not this is exactly what's happened in the last few years, right? Would you still accept 4% as your equity risk premium, or would you demand more? I don't have the final answer. It's an empirical question. Why does that matter? If risk premiums become larger as risk-free rates get higher, then I've got to factor in where risk-free rates are to decide whether 4.33% is enough. So to answer the question, I'll decide to look at the data. So in this graph, what you have, the blue is the T-bond rate, the red is that expected return on, is the risk premium on top. You add the two numbers up, that's the expected return on stocks. If you look at the last, maybe since 2008, the expected return on stocks has been between 8.5% and 9%. Much of the time, of course, the bottom was 2020 and 2021, that expected return dropped to about 5 to 6%. So one way to think about this again is to say, look, if the expected return is way below what it's been historically, you're going to see a bounce back effect. But as far as the relationship between what the level of the risk-free rate and equity risk premium, in the US, outside of the 1970s, there's been no link. In other words, risk premium doesn't get higher at higher rates and lower at lower rates. 1970s was the exception. That was a period when inflation pushed up rates and equity risk premiums actually went down. Some of you are working with companies and countries with much higher risk-free rates in the US. And the equity risk premiums you see on my page are dollar equity risk premiums on a T-bond rate. So if your risk-free rate is 15%, in the Turkish company I was valuing in Turkish lira. The risk-free rate yesterday was 22.5%. That was the risk-free rate. I'm feeling a little queasy about taking my US dollar risk premiums and adding it on top because I think I'm going to underestimate the risk premium at that level. So we'll talk about how to adjust risk premiums when your risk-free rates start to vary. But in the US, I think you can get away using implied premiums even as rates change because historically there's been no link. So if I asked you to describe what the equity risk premium is, can you give me a working definition of what is it measuring? Yes.
Added return you would want to be compensated for the added risk.
It's great. It's a price of risk in the equity market, right? That's basically the price you're charging. What goes into the price? How scared you are, what's happening, all of those feed in. It's a price of risk in the equity market. Is there a price of risk in the bond market? When you buy a corporate bond, a default spread, right? Should the two move together? When people get scared in the equity market, do you think they get scared in the bond market? It's the same people usually, right? So here's what I did. I actually took the implied equity risk premium. That's a red line. I also computed the spread on a BAA rated bond. That's an investment grade bond every year. It's market information. I put them on the same graph. Most of the time, they move together. But there have been times, 2 times at least, in the last 50 years, where the two have moved in opposite directions, and neither has had a good ending to the story. First was in the 1990s. There's the equity risk premium. It's imploding. Down to 2%, remember? This is the spread on a BAA rated. BAA is a very safe corporate bond. It's an investment grade bond. And there was a time in 1999 where you were making more by buying an investment grade bond than you were buying equities. That was the dot-com boom. What does that mean? If you're an investor and you're looking at both these numbers and you're deciding where to put your portfolio, Sophia, help me out. 1999, I'm offering you 2% on equities, and I'm offering you 2.3% on a BAA rated bond. You put all your money in the corporate bond. Why? Because you're getting a better payoff on risk. And that would have been a good call because the dot-com boom bust. And you'd have been okay with your bonds. That's the first disparity. The second was what happened after 9/11 in the US, where Alan Greenspan said, I will not allow the US economy to go into recession. The hubris of central bankers. And the way he decided to put this into practice, he tried to push down default spreads in the bond market by yapping about rates and talking about risk, and it worked. Default spreads, if you look at what happened post to, there's the black line dropping off, equity risk premiums stay high. So let's say it's 2006, and I say, where should you put your money? Should you put it in bonds where you're making this tiny spread for an investment grade bond or go into equities? The answer would have been the exact opposite of Sophia's answer in 1999. And of course, what you have here, people are not charging enough for default risk, right? You look at every market crisis in the US in the last century, almost every one of them was caused by equity investors behaving badly, except for 2008. 2008 was a crisis created by bond market investors and lenders behaving badly. I mean, there are lots of different reasons you can give for 2008, but here was the core reason. When you lend money at rates that are too low, which is what you're doing when your default spread is too low, eventually it's going to blow up on you because the actual default risk doesn't wait in the corner saying, okay, if you tell me it's low, we'll stay low. 2008, actual default risk rose to the surface. And of course, the bond market took the stock market down with it. But the reason I track these two numbers is to get a measure of when the next divergence is going to happen. I haven't seen it since 2008. Most of the years, when one goes up, the other goes up. And you see the latest variant last year, the equity risk premium went down, so did the default spread. Okay? Yeah.
Is there any meaning between the size of the spread?
I did the ratio. I looked at the ratio. Typically, it's about twice the BAA default spread. That's the average across time. Right now, it's much higher than that, which means that either stocks are cheap or bonds are expensive. You take your pick, right? But the ratio, I think, is a number that I track. It's not something that's big enough for me to trigger a red flag warning that I have to do, excessive things, but that ratio is. See, how come people didn't see this? Because once you go to work, you work in a echo chamber where you don't even know the rest of the world exists. You go to work in equities, all you care about is equities, right? You go to work in fixed income, all you look at is fixed income. You know how infrequently the two people talk to each other? This was happening under the surface and people didn't even notice because each group was so focused on its own market that they missed the fact that there was this mismatch going on. So there's the equity market, there's a bond market. There's another really big asset class I'm missing, right? So what is it? You're on to something, but what does the mortgage market derive its value from? What's the asset class it derives its value from? Real estate. One of the biggest asset classes out there. Is there an equivalent price of risk in the real estate market? Anybody worked in real estate? Yep. It's a cap rate. Real estate people like to invent their own concoctions. A cap rate is just an expected return, just like stocks and bonds. Why didn't they just call it an expected return? Because they want to make it look like they're special. A cap rate. So when real estate investors get really happy, the cap rate goes down. When they get really scared, the cap rate goes up. A cap rate just allows you to capitalize income. So if you have $1 million in rental income, the cap rate becomes a number that you use to convert it to a value. So lower cap rates give you a higher value. So it looks very much like an expected return. So I decided to bring that into the equation as well. Why leave it outside? No, come to the party. So now I have three different prices of risk on the same graph. Red line is the equity risk premium. The black is the risk premium in the bond market. You're saying, what the heck is the green line? It's the difference between the cap rate and a risk-free rate. And there seems to be something strange going on, at least pre-2000, right? You have a negative risk premium. Sounds weird until you remember what made real estate such an alluring asset class for many investors. When I did my MBA, one of the things we were told is you should invest in real estate in addition to financial assets. And what's the logic for that, Sophia? Because it doesn't move when financial markets. And when that advice came to me in 1981, it was absolutely true. Real estate actually was negatively correlated with stocks and bonds. So when you add something that's negatively correlated, you're actually reducing risk in your portfolio. So people said, you know what, I'm getting a lower return on real estate than I would have in something risk-free, but by adding it to my portfolio, I'm making it safer. And then we sold people on the idea that they should invest in real estate. The problem with investing in real estate comes in big lumps. You know what I mean by big lumps, right? You got to buy a building. So starting in the early 80s, we decided that it would be nice if people could trade on real estate without investing $1 million in a house. Hence was born mortgage-backed securities, and we securitized real estate. This is a happy ending, right? Great story. But here's the problem. When you securitize real estate, it stops behaving like real estate. It starts behaving like stocks and bonds. So take a look at what's happened since in the last 20 years. Real estate is starting to look just like stocks and bonds. You know how this manifests itself? You have a bad year for stocks, 2022. Stocks are down. You look at your portfolio. Oh my God, let me look at my bond portfolio. Also bad. And then you take a look at how much your house is worth, and what are you going to say? It's also down. This is a terrifying development. Because in the old days, the flight to safety that you had in crisis, you sold your stocks and bonds and bought things that were uncorrelated. Real estate was a logical place. I've taken that place of safety away because it's now starting to look just like stocks and bonds. Securitization has this side effect that I don't think we talk about. We talk about all the great things about securitization. It allows people to trade, you're right. But in the process of securitizing things, we're making it behave more and more like traditional stocks and bonds. And once you do that, you take away the allure it has as a separate asset class. So as I said, I do implied equity risk premiums all the time. I've been trying to sell appraisers, analysts, and bankers on the idea that they should stop using historical risk premiums and use implied premiums instead. So I'm going to give you the counter I get from some, from some investment bankers as to why they think it's still okay to use historical risk premiums. Actually, a conversation I had with the banker, I updated the numbers. I came up with an implied equity risk premium, let's say 4.33%. What did I say? That's what I would use. The banker said that's okay. We use 8.44% as our equity risk premium, but it's okay because everybody in our group uses 8.44%. You see the logic, right? If everybody uses the same risk, implied equity risk premium or the same equity risk, why does it matter whether it's right or wrong as long as it's all consistent? Tell me what's going to happen in this equity research group. The market's pricing stocks with a 4.33% premium. Every person in the group has to use an 8.44% premium. Play it through. What do you think will happen to the cost of equity? Go ahead. Flip it around. You're going to put up 8.44%. So your discount rate is going to be too high. Your values are going to be too low. Everything is going to look expensive to you, right? Because the price is going to be much, much higher than the value. So when you use a high discount rate, remember you underestimate value and you buy when something is cheap. And here you made your values all too low. Nothing is going to look cheap to you. Everything you look at will be a sell. And as a sell-side analyst, you won't survive for very long if you put a sell recommendation in everything you do. So what do? You start playing games with the earnings and cash flows. You want to put a buy recommendation. I forced you to use an unrealistically high cost of equity. What's the only way you compensate for it? Use a growth rate. That's twice the size it should be. This is the path to bad valuation because, in a sense, to compensate for one mistake, you create another mistake and you're hoping that they somehow offset each other. But what universe is that going to be true? So don't let investment bankers say, it's okay, we all use 5%. You still have to ask the question, is 5% reasonable? And the only way to address that question is to actually compute an implied equity risk premium as of that time. And if it's close to 5%, you're going to say, that's okay. But if it's 3% and using 5%, you say everything's going to look overvalued. And if it's 7% like it was in COVID and using 5%, everything's going to look cheap to you. This is no way to value companies. So even if you don't buy into my implied equity risk premium, I'll give you the spreadsheet. You can modify it because by now you know the logic I'm trying to come up with. So you don't like the way I get the growth rate, that's fine. Come up with a different way of getting growth rate. But this isn't, again, I'm not creating some elaborate theoretical exercise, the pure internal rate of return calculation. And it's an incredibly useful number to know, even if you decide not to use it. Right? So is everybody clear on why you get the values you get will be too low? You use too high a discount. So anytime you use an equity risk premium higher than the actual implied premium, you're going to push down the values of everything. And if you're an equity research analyst, that'll create cells. And if you use an equity risk premium that's lower than the implied premium, you'll get the exact opposite happening. So let's look at the choices here. You have historical premiums, you got implied equity risk premiums, and you have different variations of implied premiums. You can use today's implied premium, you can average out the premium, you can do all kinds of neat stuff. But ultimately, how do we decide which one is the best estimate? What's the end game here? What are we trying to do? We're trying to figure out what stocks will do in the future, what the actual returns are. So if you have a good measure of an equity risk premium, it should at least be correlated with what stocks actually deliver. Agree? And the higher the correlation, the better the estimate of the equity risk premium. So I actually take 6 or 7 different measures of the implied premium, and I went through a few of them here. And I look at this correlation. So remember, you want high positive numbers. That's a good. I've taken 4 different variations. Current implied premium, 4.33%. Maybe you like to smooth things out, an average premium of the last 5 years. A historical premium, or just take the default spread and multiply by 2. It's kind of a very rough estimate based on history. Of the 4 approaches to estimating equity risk premiums, which is the worst one? What did we say we wanted the correlation? High, positive number. You want to be forecasting actual returns being higher. Take a look at the historical premium. It's not even a low, it's a negative correlation. This is about as perverse an estimate as you can get. So you are an appraiser using historical risk premiums, using a high number when it should be low and a low number when it should be high. And among the other 3, the current implied premium actually does the best job in forecasting actual returns in the next year, the next 5 years, the next 10 years. My defense for using the current premium is not based on some ego. It's based on the fact it works better. If I'd found the default spread-based approach work better, I'd say multiply the default spread by 2. Think of how much easier my life would be at the start of every month. So I will continue to use the current implied premium. I'll update in February. But you don't have to wait for me to update. I might take it, sometimes it takes me a couple of days in March to get to it. You can beat me to it. You'll have the same spreadsheet I'm going to be using. You'll have in today's email, you'll get as a link. Update it. All you have to do is update the index, update the T-bond rate, run the goal seek function. It comes with instructions on how to run it. You can update it every day if you want. I hope there's no crisis, but if there is an incentive for you. It's a good way to get a sense of what it is that's driving it. Now, when I did historical premiums, remember I said it's almost impossible to do this for an emerging market. Why is that again? Why is it difficult to get historical risk premiums that you can use in a Vietnam or a... There's not enough data, right? But if I do an implied premium, can I do it for any market, no matter how short its history? What are the things I need? I need the level of the index. I can get that in any market. I need cash flows last year. I should be able to get it. Might be only dividends in that market. I need expected growth for the next 5 years. And it's tricky in a Vietnamese market, but if I, tried to, if I was a pragmatist, I could probably come up with a number. But if I can get those numbers, I can solve for an implied equity risk premium for a market. So let's try this. This was in 2007. I wanted to get an implied equity risk premium for the Sensex, the Indian Equity Index. So I got the level of the index, 15,446. Dividends were the only thing. There were no buybacks in India at that time. So all I had to do was, so it actually made my life easier. For the expected growth, I had to cheat. Because unlike the S&P 500, where there are analysts who forecast earnings growth for the entire index, here I had to get growth rates for individual companies. And for most of them, I got a growth rate only for 1 year. The only companies where I could get a 5-year growth rate were Indian companies with ADRs. You know what ADRs are? They're listings in the US. So the companies like Infosys that had ADRs, but I kind of cobbled together the numbers and I came up with a growth rate of 14%. The risk-free rate that I had then for the Indian rupee was 6.76%. So I'm going to set up the process. I have the level of the index. I've projected cash flows with a 14% growth rate. At the end of the 5th year, I assume that cash flow will continue to grow at a 6.76% rate. And I solved for a required rate of return, 11.18%. You subtract out the risk-free rate then, the implied equity risk premium for India in 2007 was 4.42%. Last week, I did this for the Sensex right now. Anybody who's been tracking Indian equities, what have they been doing for the last decade? really good things if you're an investor. Indexes at sky high. In fact, you talked about price earnings ratios for US stocks looking high at 21, 22. India was the priciest market in the world at the start of 2025, 31 times earnings. All of this, if you put the numbers in an implied equity risk premium, the implied equity risk premium in India right now is about 3%. Remind me again what the premium was for the US at the start of 2025? 4.33%. Now you can do all your India story dances you want about the growth and the amazing thing. I've built that all into the cash flows with the growth rate. If you're accepting a 3% premium for a market that still has substantially more risk than a developed, mature market, you've got to be out of your mind, right? But I'll cut Indians some slack on this. When I'm an investor and I'm looking at the US equity risk premium at 4.33% and the Indian premium is 3%, how does that play out in my portfolio choices? I can choose where to invest my money, right? So guess where I invest my money? More in US stocks, very little in Indian stocks. Why can't Indian investors do the same? I want somebody from India to answer this question. Why can't Indian investors pull their money out of Indian stocks? After all, they're incredibly overpriced, and move them to the US, the UK, Germany. Yes. There are restrictions. You can invest up to what, $250,000. And basically, so you are in a sense, and be glad it's 250,000, because when I was growing up, it was $0. You could not invest outside India. If you corral people and force them to invest in a market, you don't give them escape hatches. It's a very dangerous thing to do. You think they got away with it 40 years ago when India was a tiny economy in terms of GDP. Now we have what, the 5th largest economy in the world? China has a variation of the same problem. I'm talking about mainland China versus Hong Kong. Is you had to put corrals. Countries are getting wealthier. There's more money to invest, and there's no place to go. So what do? You pile into equities, even though the premium is too low. But even in markets like India, where I give you no escape hatches, at some point in time, you're going to say, no, I'm not doing this anymore. And then what do? You take your money out of stocks, you go looking for something else to invest in. In India, historically, this was real estate, this was gold. Basically, you have a moving bubble. With this much money, it's got to go somewhere. So what's the fix? What should the Indian government start doing? Kind of logically follows. You got to remove these capital controls. You got to do it gradually. You know why you got to do it gradually, right? If you remove them all tomorrow, what's going to happen? Indian equities are going to collapse. Every Indian company is going to go, what the heck happened here? Because you've given them this great way of raising capital at really low expected returns. They're not going to voluntarily say, this is amazing, go ahead and take the capital. But you got to start doing this. India is not a small economy anymore. And if the India story is even partially true, this problem is only going to get worse rather than better. And the nice thing about implied premiums is you can essentially make this statement. And you're not making a statement about qualitatively. I'm not saying this. It's really about this is what the numbers are giving me as an expected return and a risk premium. So on that note, I will leave you to your thoughts, and I will see you on Wednesday.